What's good, YouTube? It's your boy Zay, and welcome back to another Setup Sunday. And man, oh man, yo, this market, what can we say about this market? It needs to make up its mind, right? It really needs to make up its mind. Last week was hella flat, but when you think about it, it was the last week of April, and we just had a huge earnings week, which we talked about last week. And so Wall Street and investors were really just trying to make up their mind as far as where do we go from here? Based on what we heard from some of the top companies, have blowout quarters, report some even reported record-breaking numbers, and Wall Street is just trying to take all of that data as well as what they're hearing from the Fed and what we know about inflation and just everything that is, with the economy reopening. There's just a lot going on. There's a lot of good news. There's a lot of good news, and it's like, okay, is this sustainable? Can we actually keep this going? Especially after we just had that huge run up in 2020. So as you guys know, a bull market can span over multiple years. So, I kind of see this as a pause in a multiple year bull run. And we're going to get all of that. We're going to get into all of that today in today's episode. Today's episode is going to be a little bit different, right? So versus looking at it from just a week to week standpoint, we're going to reflect on the month of April. We're going to look at, okay, because I see two scenarios that could possibly happen in May going into June. As we all know, it's officially May, so next month is June. So quad witching is upon us. And there is a saying of sell in May and go away. So I want to address all of that in today's episode. Also, there's some, I would say, conflicting data that shows us, hey, based on prior history trends, the market could go either south or we could go break out to the upside. So I really want to break down what those two scenarios are, talk about the catalyst that we see, and kind of play it out from a technical standpoint, so that way you guys can kind of get a feel for, okay, when I hear this news and if the market reacts this way, potentially we could be looking at this scenario. So at the end of the day, you'll know how to plan for both scenarios depending on how it plays out. So again, guys, I hope y'all are enjoying these videos. Don't forget to press that like button. Don't forget to hit that subscribe button, Jesus Christ, as well as the notification bell, so that way whenever I drop a video, you are in the know. Now, with that said, we're going to skip the articles for this week, right? Because what we're going to do is we're going to actually talk about the articles and the data and the economics while we work through the charts. So it's going to be a little bit different. So this episode is going to be really cool. I got some really dope graphs that I'm going to show and share so we can talk about the conflicting information and really try to piece together the puzzle of, okay, where does this market go next? What can we see possibly happening so we can position ourselves and take advantage of this bull market that we're in. So with that being said, let's go ahead and get right into these charts. All right, fam. So y'all already know how we like to kick it off. We like to kick it off on the charts. Now today, before we get into the charts, as I mentioned earlier, there's a lot of mixed signals that the market seems to be presenting. And so when you are at a point where, as what I would call an inflection point, and you need to figure out, okay, what happens next? A lot of investors will tend to look at, the economics, the fundamentals, as well as previous trends and what has happened. So with that being said, before we get into the charts, there are a few historical trends that I would like us to take a look at, right? Now, the first is going to be, and I grabbed these screenshots or these pictures from the 2021 Stock Traders Almanac. Now, when you look at this, right, this is the Nasdaq Composites 1-year pattern, 1971 through 2019. Now, what I want you guys to pay attention to most is right here, post-election years and what typically happens. Now, if we think about the beginning of 2021, we had a nice run up in January and going into February, right about into the middle. Then we had our correction all the way down to, basically the end of February going into March. And then into April, we had a nice boom in the beginning. And now we've kind of traded sideways since the middle of April. And then now we are here at May. And when you look at post-election years, May through July, what happens to the market? Well, the Nasdaq at least experiences another big boost in early May. You get somewhat of a little bit of dip in the middle of May, and then going into June and July, you kind of just, as you see, you run right all the way through it. You get somewhat of a pullback kind of in the middle of May and into July, which this right here would be June's quad witching, and then July you get a big boom going into August, right? So that is the Nasdaq's historical trend or 1 year pattern, and this is what it typically does, right? Now, this is the Russell 1000 and the Russell 2000. These are smaller indexes, but as you can see, you see something very similar where you get a big boom going from May into June and July, all the way into August. Same thing post-election years. When you look at the Russell 1000 post-election years, same scenario. You get a nice run up May into June, into July, all the way into August. So that right there is one set of data that we can look at to potentially figure out where could the market go next now that we are entering May. So the next graph or picture that I actually wanted to share with you guys is the S&P. Same thing for the S&P. When you look at, and we're going to focus on 1950 to 2019, these are just other years. When you look at 1950 to 2019, post-election years, what happens to the S&P 500? You can see in January to February, you get a nice little run up, and then February, the correction starts going into early March. This trades a little bit flat. You get into April, going into May, right? You get a big boom early April, kind of trades sideways a little bit in May. And then ultimately, when you get into May, you get another big run. Into June, kind of trades sideways, a dip. Remember, quad witching, kind of quad witching. And then you get a big boom in July going into August. And so this is the S&P 500. So I want you to keep these historical trends in mind as we go through the charts today, because this is just one scenario. Now, post-election, as we've seen for the Nasdaq, S&P, Russell 1000, we just went through, typically in May, going through June and July, you have somewhat of a run, trade flat sideways, and then you get a big boom from July going into August. So I really want you guys to just keep that in mind, all right? Now, the last historical data point that I want you to take into account, which offers a conflicting view or a contrarian view of what we just saw, is going to be this graph here, comparing the SPX or the S&P 500 2009 from 2010 to 2020, 2021. So as you can see, guys, this is an overlay. Orange is 2020 to 2021, and then the green is 09 and 2010. As you can see, we had this similar recession, and then not only see an economic boom, but recovery, right? Now, what I want to point out with these graphs is that there's a bit of divergence between them. While the trends are very similar, there's often key inflection points that you can easily identify. Whereas when you look right here, early in May, we had a big boom, whereas in 2020, it was actually a pullback in May and June last year. Then you had a huge, massive run up where here we kind of actually pulled back, right? So this is the inflection point. Now, what I want you to do is pay attention to here. So we kind of peaked out in September of 2020, whereas we were on a dip in 09 and 2010. Same thing here. We had a nice run from about September 09. You got a little bit of a dip in October into November, right? October. Whereas last year in 2020, we had a major pullback in September. We had a bounce. Then you had the election correction right here. And now we've started to chug along, right? So inflection. Then you get here another inflection point where in 2009, 2010, in February, we had a hard pullback going early into the year. And then in March, it absolutely took off going into April and May. Whereas with 2020, we had a huge dip in February and March. So divergence. And now we bounced and had a nice run. So that leads me to believe either based on this chart, we can either come down and start correcting like we did in 2009, 2010, which would be a sell in May type of thing, or the divergence continues. And instead of seeing a dip, as we saw in May going into June and July, we continue to see a massive run up or melt up, right? Because if these charts are going to continue to be divergent as we see it, then that would mean that, hey, we might have a little bit of a dip and then we're going to really run hot, right? And whereas when we started to run hot here, maybe this is where we start to cool off, which brings it in line with, if you look, this would be September quad witching, which ultimately, if it's divergence, instead of going on a boom, we'd be kind of coming down, cooling off, getting ready for a boom into the back half of the year. So that's just a few different data points that when you're building a technical thesis that you want to use to kind of craft and say, okay, I've seen these situations, I have that data now, let me piece together the map of what I see going into where we are right now as far as current times, right? So I really just wanted to walk y'all through that just so you can kind of get a feel for how we're going to look at the charts moving forward going into May and June in the back half of the year, because today's episode, that's what it's going to be really about, is just focusing on what happens these next couple of months, couple of weeks, right? Or what potentially could happen. So let's get into our first chart of the week, which is the Nasdaq, right? So if we just to do a quick recap, last week we pointed out our resistance and support lines, and as you can see, last week we hit a high of 14,211. We talked about, hey, we needed to get above that 14,175 level. We hit it and we got rejected, and then essentially we came back down to support, which is around this 13,962, again roughly around the 14,000 level. Our main support that we want to see hold is 13,700, which we did not get down to. So again, the market was relatively flat. We didn't trade, we didn't have much movement. There was like a lot of movement intraday, but overall from a weekly perspective, you can see the market was down 0.39%. So not much movement, really flat. So with that being said, where do we go from here? Okay, so when you think about the Nasdaq and last week's earnings reports, blowout. However, the market did not respond to it. So I mean, we had Facebook, we had Apple, all of the top tech companies reported some blowout earnings. I mean, Amazon doesn't get much better than those numbers, right? And yet the market did not reward any or barely any of them. Like, it just didn't really move. So where do we go from here, right? What decision do investors make? So based on from a technical standpoint, we know that the fundamentals are strong because of what happened in earnings. But the question is, can that be sustained? And we, because of all of the uncertainty when it comes to, will the Fed start tapering bond buying? There's another big meeting that happens in June that we'll need to pay attention to, where Jerome Powell and a lot of investors are thinking that ultimately that is when he'll have to make a decision. And so again, these are other economic and fundamental things that we need to take into account when we do our TA, or that's what I take into account when I do TA. So when I'm providing these weekly updates, I do think about these things when I'm looking at projections and how they play into the numbers. So again, looking at the Nasdaq, where do we go from here? Ultimately, the first week of Nasdaq, I think because of last week's kind of the being of the last week of April, most investors kind of sit on their hands. They wanted to see how earnings played out. They're, rerunning their projections and getting the numbers right. That I believe the first week of May is going to be a powerful up week. We should have a bullish week next week, because ultimately buyers may start stepping in based on what they've heard and the data that we have seen going forward. So what do we need to pay attention to? So for the Nasdaq, again, our support and resistance hasn't changed. So again, we have resistance here at 14,038, at 14,050. If we can close above that, like we did on Monday, then we'll have a shot at 14,175, 14,177. We need to get a close above 14,175. If we get a close above that, then again, I do believe that 14.4 is in play, and that would be the first level that we would need to take or get to. And don't be surprised if we push to about 14,500. I mean, that could possibly be, if we start to melt up, that could be a target as well. But for me, I'm going to be a little conservative, and I'm thinking 14.4 is where
ultimately I would like to see the Nasdaq get. To the downside, if we don't get that upward movement that we believe we should get, then of course you can see our 20-day moving average is right here at the 13,922. So I'll go ahead and add another resistance there for us. So again, we need to make sure 13,922 holds. If that does not hold, then of course we'd be looking to come down to this 13,700, which was previous support. Again, we would need to see this hold, and if we broke or had a close below 13,700, then of course we could be coming to ultimately fill this gap and come touch our 50-day exponential moving average, which is roughly around that 13,500. So a lot of price action, but just let the price dictate where the market is going. You just need to say, okay, what are the prices giving me? What direction is it pointing? And don't fight against the trend. So that is the Nasdaq's assessment. So you have your levels and what we need to be paying attention to. So with that being said, let's get into the QQQs. All right. So looking at the Qs last week, as you can see, let me go ahead and change it to a weekly. Again, pretty flat. We hit a high of 342.80, a low of 336.90. So pretty much right in our support and resistance levels that we outlined last week. So again, not much has really changed when it comes to the Qs. Looking at where we are, we did get a this kind of a reverse hammer. So this sometimes does signal a reversal and that we could start an uptrend. We did close above our 20-day moving average, which is another good thing. So again, to the upside, what we need to see is we need to get above this 342. We need a close above 342. As you can see last week, every time we got there, we got rejected. So we get a close above 342. Again, 345 and 350 are in play. First, we would need to get 345. And then after that, 350 would be the next logical target. If we don't, and if we decide to break down, then again, you can see where our first level of support is right around at 334. Actually, I'll tighten it up. So yeah, 334. And then if that does not hold, then we would look to see if 330 would serve as support. And again, if we get a close below 330, then ultimately we're coming down to about 325, which is where the 50-day exponential moving average is. So that is the Qs, right? That is the Qs as far as what levels to pay attention to. And so with that being said, we're going to go ahead and get into the SPX. So looking at the SPX, again, flat week, no movement. We hit a high of 42.18, hit a low of 41.74, which served as support. And as I said, I think 481 was really our resistance, and we just stayed right there. Again, a little intraday movement, but not much. So when we go and look at it from where can we go from here, this is a chart that does kind of concern me because we have a false breakout in what they would call a hanging man, and now we have a red candle that's signaling downside. We also have a little divergence here on the RSI. So that's what I'm paying attention to. But this could be a false signal just because it's giving you the presentation that, hey, it looks like it's going to the downside. We could go to the downside and ultimately bounce and have that bullish momentum. So for the SPX, what I'll be paying attention to this week is, again, ultimately this 41.81 has to hold. As you can see, we just basically been trading flat or sideways. So I'm gonna go ahead and adjust our support here. So 41.78 is going to be support. We have to hold this level. If we do, then again, we would want to look to get back up to about that 42.12. And from 42.12, I think the target for me is going to be about 42.50 to the upside. I think that's what we can push. Ultimately, maybe 4,300 is where we try to get to by the end of May. So I'm going to go ahead and add that level of resistance as well. So to the upside, when we get into the month of May, the levels to watch for, especially next week, is just a close above the 481, get into 42.12. If we can close above 42.12, then 42.50 is in range. If we break down, meaning go to the downside, and this 41.78 does not hold, Again, you have the 20-day moving average at 41.47. That'd be the first level that would serve as support. And ultimately, the bears would try to break this level and get us down to this 41.20. So 41.20 would have to hold as support. If the bears can push us down below 41.20, then again, 40.75 could serve as a support. If not, I do think once we get a close below 40.75, it's coming down to close up these gaps, and we could ultimately see about 39.80, close to 4,000 on the SPX. So, and next week, in the coming weeks, these are going to be those levels to pay attention to. And again, we do this every Sunday, so we'll always get a good update. So with that being said, let's get into the SPY. So getting into the SPY, as you can see, guys, again, repeating myself, flat week. All we did was get up to 420, right? 420.72, and we hit a low of 416.30. So where do we go from here? Again, the first week of May tends to be a pretty good up week. So I would want to see us get a close above this 418. If we get a close above 418, then 424, 423 is the area of resistance you want to look to get to. We could probably push up to 424 or 423. If we continue rejection at 418 and we go to the downside, you can see that 413.85 is where our 20-day moving average is. So we would want to make sure that holds as support. If this level does not hold, then ultimately we're looking at that 410.62 area that has to be support. And the bears can get us below 410 or close below 410. Then ultimately there is not much structure holding this up. So they probably blast through this 403.05 and try to push us down to about 396.45 on the SPY. And if you look, the 50-day exponential moving average is right at 399.54. So these are your downside targets to look for. Again, the market feels like it wants to make a decision whether it goes to the upside or to the downside. So you need to know what to look out for. With that being said, we're going to get into next is now the Dow Jones, or the DIA ETF. Again, flat week, changing it to the weekly. We have two rejection candles here. These are inside, so what we could look to see is a nice green candle push us up to about 346 next week, because the first week of May is typically bullish. So if that is, or right, if we don't get this big green bar, we could see probably a red bar that would bring us down to about 331.59 or so. So let's break that down from a daily perspective, right? What does that look like? So right now we have a close above our 20-day moving average. So that would support at 338, right? So it's right in between our resistance and support area. So if we get a break, we need to get a close above 341.60 in order to make that run to the upside of 346 or so. If we don't, and we get rejection at this 341 and we come back down to this 336, and this does not hold, and say we get a close below this 336.83, then the next target would be 331.67, kind of clean up this gap. And ultimately, if this gave way, then ultimately 325 would be the next level support that I would look for, which brings us right below our 50-day exponential moving average, which is right around 328, and kind of clean this gap up as well. So that is what I'm looking for in the Dow Jones. And the biggest thing that I like to point out with the Dow Jones is look at this RSI divergence right here. So if you look, this is still trending down, and at the same time the market has been going flat. So if this has like a major break, then that means we're coming to that. But if we bounce to this upside and get to the 70, that's what could cause that final push to the 347, and you'd look to see the RSI bounce up and get back to about that 70, which signals, hey, we're pretty much super overbought at that point. So that is the Dow Jones levels and kind of what we need to pay attention to for the DIA ETF. Getting into the US 10-year Treasury next. So looking at the US 10-year Treasury. So last week, I believe that I talked about it pushing down to this support area, and we got a huge bounce. Now, I think this is just a dead cat bounce, right? So a dead cat bounce is where you have a downtrend, you get a bounce, and then ultimately it keeps going down. The reason I believe that is because you have the 20-day moving average sitting here at 1.35, and you have the 50-day still at roughly 1. Now, I don't see the US 10-year Treasury coming all the way back down to these levels. It's probably just going to trade sideways flat until these moving averages can catch up. So that's why I do believe that ultimately this 1.49 is still the support that we have to get to. We did get some rejection here. So if we can push back under this 6.12, then ultimately I think over the next week or two, we can see the US 10-year Treasury push back down to about 1.5. Keep in mind with the US 10-year Treasury, and this is something that I have written in my Stock Traders Almanac. I always keep detailed notes. Wednesday, May 5th, the 10-year Treasury note, they have their announcement date. The auction itself is on Wednesday, May 12th, and the settlement date is on Monday, the 17th. Please keep that in mind. Keep that in mind, because ultimately that could, having that auction we could see some movement within the US 10-year Treasury. The last time we had an auction was right around March, and the settlement date, and you can see it started to trend down. So this is what gives me another indication that, hey, dead cat bounce to kind of get some interest in buying the US 10-year Treasuries. And then when the auction happens, you see another slide, and eventually we come back down to 1.5, 1.45. So tying in economic and fundamental data into what I see with the technicals, which is why this is why I kind of see for the next 2 weeks we could be headed down. If that does not turn out to be true, right, and we continue to the upside, then we know the levels to pay attention to. You have a 1.75, which is resistance, and if we crack 1.75, then of course it looks like we could be headed to that 1.95 2.0 range. Now, I do believe that the US 10-year Treasury will end the year around 2%. So we need to be mindful of that and get ready for that. So again, when the US 10-year Treasury is going up crazy, or how fast it's going up, it tends to spook the Nasdaq or growth investors. So if there's like a pullback or something, go check out the US 10-year Treasury to see what that's doing. All right, so enough on the US 10-year Treasury. Let's get into the VIX. So looking at the VIX, again, we had a green week on the VIX. And again, it's hovering right at our 18.8 resistance level. So it got up and got rejected. Same thing happened here. Ran up, got rejected. So this is a good sign. A lot of rejection at the 200-day moving average, while the 50-day moving average and the 20-day moving average are still sloping down. So that means the VIX is calming down, volatility is calming down, and the market is returning to normal. As long as we continue to trade under 20, we are still in a bull market. If the VIX cracks above 20, we want to pay attention to a stock market correction. That is the key thing to pay attention. If we get above 20, stock market correction. As long as we're below 20, still in a bull market. So when we look at the VIX and what potentially could happen to the upside, the levels to pay attention to could be a bounce or more upside from this 18.8 to about 21.8, which would trigger just a slight scare, right? That it probably trigger a slight scare. If we crack 21.8, then 24.925 is in play, because that is where the 50-day moving average is. Now, I do expect rejection here, but that spike up is going to cause some volatility. And when volatility gets introduced to the market, then we know, hey, it's either could tend to be some downside. Now, take that with a grain of salt, because last year in 2020, we had a very, very high VIX and the market continued to climb. So we could always get an opposite reaction. When we look at our levels from a daily perspective, as you can see, looking at the VIX from a daily perspective, this thing has really been trading between 18.8 and our 17.4 level, just stuck. As you can see, just, it goes up and down, up and down. So this has been that whole sideways trading. Now, when you look at it from a daily perspective and you see this rejection at the 18.8, this is why I say, hey, potentially it could break out the bands and come up to about this 20, but then it would get pushed back down and ultimately kind of come back down to our 7.3. So as I look at the VIX next week, thinking about the first week of May being very bullish, I do believe that we could see the VIX come back down to our 20-day moving average, which is around our 17.3. And if we get a close below 17.3, Would love to see the VIX get pushed back down to that 16.1 and continue some bullish momentum. But again, the upside targets we do need to pay attention to on the VIX, as well as we have a sloping RSI. We have a sloping RSI, which again is this has been resistant, so we could see it get shot back down, and then it goes down in May, and then in June when quad witching, we see a good spike going into quad witching. So again, I'm trying to give you guys more of a longer term perspective, not just week to week, but hey, this is what we see on the week, and then longer term, this is how we kind of want to track it to see if it's playing out to our thesis. All right. So that is the VIX. Ultimately, what we want to do now is wrap it up with Bitcoin and Ethereum. And then I'm going to take it back and kind of walk through May and June and the back half of the year of just some upside, downside targets as far as what I see, and kind of actually throw some fibs and stuff like that. So it's going to be really dope. All right. Bitcoin. So looking at Bitcoin, Bitcoin is doing this thug thizzle. I did call out that I thought we would see another red candle last week, but instead it bounced. Now, again, I think Bitcoin is giving us the same dead cat bounces as far as the US 10-year treasury goes. Now, what we'll need to see is, can Bitcoin get through this 59,000 and have some follow through next week into that first week of May? If Bitcoin can get some follow through and close above 59,000, then hey, it could be on its way back to 65,000 all the way up to 70K. If we continue to get rejection at 59,000, then ultimately we could see it come back down to try the 52,250 level. And if that does not hold, then again, we could possibly see 44,375 on Bitcoin or so. Right. And if this 44,000, 45K does not hold, then again, I don't see much structure here or support. So ultimately, we could end up seeing Bitcoin drop down to about 37, 38K, all the way as low as 31,710, roughly, 30,000, because Bitcoin likes even numbers. So 31,000, 30,000 to the downside. And again, this is all over the month of May going into June, right? So as you can see from a technical standpoint, we have huge divergence on the RSI. I mean, a huge divergence on the RSI. And as you can see, we hit a high here, we kind of had that bounce, and then we went here, and then we got another one. Now it's traded sideways, went down, we got a bounce. So what do you expect to happen when this thing goes down again? It's probably gonna be another huge, red candles kind of, what was that, 20%? Yeah, 12%. This one was 21%, 20% sell off on Bitcoin. And just to kind of show you guys, add some sauce, if we go from the current price of 56,000 and do another, say 20%, look where that brings you. 20% brings you right down to my first target, which is that 44,000, right at 45,000, right? So that's what I'm saying. Like, sometimes it's just all about proofing and kind of knowing where your levels are. So with Bitcoin, looking at the chart from a weekly standpoint, this could be a dead cat bounce, or it could be the revival of a continuing bull market, or we could see one more leg down before we ultimately do find support and then continue back up. So those are the levels to pay attention to on Bitcoin. So let's get into my bae Ethereum, because Ethereum been rocking. I think last week I called it out. We were right around 2,500 or so. I said, hey, if it comes down to 2,550, 2,500, and you see that it's continuing to go, that could be a good entry, because we could be headed to about 2,750 to 3,000. And my God, oh God, Ethereum went up and hit a high of 2,956. So we didn't get quite the 3,000, but we blew through my 2,750 price target. So for Ethereum, the question is, where do we go from here? As you can see, this is a powerful, powerful candle. I think the rotation from Bitcoin into Ethereum does continue. However, we need to be mindful that Ethereum just went on a hell of a run. So we could see some trading sideways and a little bit of a cool off. So when I get down to a daily chart, as of right now, looking at Ethereum, we have a rejection hammer right here at this 29.51. So what to pay attention to? Ultimately, I think what I would say is support is going to be found around 26.16. If we start to break down to about 25.20, right? This is right where our 20-day moving average is. So look for about 25.20 to 2600. If this support gives away and we break down, then again, we'd probably be looking for about 22.75 as support. Well, actually, I'm just going to go right here. I'm going to make a quick adjustment. So yeah, 22.10. And then you can see our 50-day exponential moving average is right at 21.25. But ultimately, I'd say this 2070, so 2100, close to 2000. I mean, if you can get 2000 on Ethereum, that's probably going to be a good buy-in price. But as you can see from a technical standpoint, there's going to, there has some giveaway. So, if it goes to 2070 and don't go quite to 2000 and it bounces back up, don't be like, you said 2000, Zay. Hey, I got you $70 within range. That's pretty good. So that's what I'll be looking at on Ethereum. I mean, Ethereum is rocking. As far as how high can it continue to go, I really, right now, I don't know. We hit my high price target of 3,000 in the interim. Again, I think I've talked about, I could see Ethereum going to 5 to 10K by the end of the year. So I just need some more data to play out so we can kind of project out the rest of the year. But so far, Ethereum's chart is looking hella bullish. I mean, just look at this candle, man. This is crazy. So, but don't go chasing. Don't go chasing. All right, so that is Ethereum, guys. Now, we went through all our charts for the week. Now, what I want to do is walk you through the SPY or S&P 500, the Nasdaq, as well as the Dow Jones, as what I see from going to May, June quad witching, and July, upside and downside projection. All right, so looking at the SPX, right? So this is June 21st. This is quad witching. Right, this is when quad witching happens, and this is when we get to July, right? So this is about how much time how much time we have for this to play out. Now, as I said, I believe this first week of May, maybe even first 2 weeks of May, we could see a nice run into May, right? So based on those previous trends and historical charts we looked at, the first 2 weeks of May could be very bullish. And if that is the case, and let me get down to just so I can show you guys some cool stuff, right? If we look, this was April, and this was the move that it made those first 2 weeks of April right here. So if I take my info line and I go to these first 2 weeks right here, this is where we were. You can see over 15 days, the S&P 500 went 4.76% over 15 days. All right. Now, if we do that same kind of math, right, and if we just take it from here and we start on May 3rd and say we get a run for the first 15 days. So we actually want to go about here to the first 2 weeks. That's actually going to be 11 days. And we get the same, say, just 4%. And I don't even want to do 4% because I'm going to be more realistic. We won't see, let's just say we get 3%. 3% will put us at 4,300, which is the target. This is very doable, right? And if I change it to the line, right, you can see how if I remove this and remove this, how this chart has kind of consolidated, and now we can go up for another leg. It's consolidated and it's ready for its next sprint. So if I do a trend line, you want to see something like this, right, over those first 2 weeks. Now, how fast does this move happen? It could be within a week, it could be 2 weeks, but the projection is there, and you can see how this will play out. If you look and just imagine this blue line continuing, that would be the move, right? Now, if we get here at this top, then ultimately we probably trade flat a little bit into May, or we'd have maybe even a little bit of a pullback, because typically what will happen is when you make a new all-time high, you're going to come back. And if I just throw the fib, I'm going to throw a Fibonacci retracement on here. If I throw a fib on, and let's say this is the top, right? And then I go down to quad witching, which is right here. And we started, this is where our move started, right down here. This is kind of where the S&P 500 took off at this 3912 area, right about 3900. Now, I know we probably can't see these numbers, so I'm going to just try to open this up a little bit, right? So if you look, right, if we come back to the 0.618, that puts us at 4152, which meets us right at our 20-day moving average. If we come down to our 0.38, that puts us at 4,061. And if we come to our 0.236 retracement, which would be 4,000, you can see how that aligns with our 50-day exponential moving average. So how would this kind of play out? Of course, you know, what could ultimately happen is we definitely are going to get somewhat of a cool off in the middle of May. So you want to see, and I'm going to use my path, right? We'll do this. Come down, which brings us at our previous resistance. So what was once resistance becomes support. Now this is going to be our worst case scenario. So we come back here the first 2 weeks. Now, mind you, Memorial Day going into June, you typically get a nice little push because, you know, people are excited about Memorial Day weekend. So then going into Memorial Day weekend, the last 2 weeks of May into June, we could probably make another push to the 4,300, right? That's going to give you that false sense that, hey, we're about to break out to go to 4,400 because that is the next target is 4,400. But I don't think that's going to happen, not in May or June, but I'm gonna get you there though. So we get this, right? So now that we're at June 1st is when we need to really be mindful about quad witching. Now, mind you, I'm looking at this from the SPX standpoint. So when we get here, we've seen that over the 3 weeks, we can see a nasty, nasty drawdown. So if the if this S&P 500 were to do a drawdown, ultimately we could see your first leg or your first sell-off, because if we hit 4,300, that's going to trigger a massive drop, right? So then the first week of June, we see something like this, probably down to where are we at? I'm trying to get to that, line it up perfectly on my numbers. All right, here we go. Boom. So we probably come to about 4180. From 4180, we can probably get a little bit of a bounce, right? That dead cat bounce into for maybe about a week or so, right? Right back up to 4,200. And then going into quad witching, we get another nasty leg down. And we come to about this 4,074, right? So what you will see here, and if I move this, is you have the formation of a double top with an ABC correction. So if you remember my Elliott waves, then this is exactly what we just plotted out. You would have, this would be ultimately your wave 3. This is 4 with a consolidation, and you get 5 to the top. And we're going to have a double top, and then you'd have an ABC correction. Now, this is just a rough estimate, but again, you can use this thesis or challenge my thesis to say, hey, you know, I don't see that necessarily playing out, or I could see that, but ultimately June quad witching is what we need to pay attention to. And this may seem like a hell of a drop or like, you know, a big significant drop, but from a percentage standpoint, I need you guys to realize that from going from 4,300 all the way down to this level, that's only a 5% drop, right? That's only a 5% decline. Some economists are calling for a 10% correction in the S&P 500. And if you got a 10% correction in the S&P 500, I mean, look, you can see 9% brings you down to roughly 3,900 flat. So from 4,300 down to 3,900, that's a 10% correction. So please, please be mindful and don't think that this can't happen, because we've seen it happen once before. It's just the way it happens is slow, it's methodical, and it doesn't all happen really, really fast in one fell swoop. It's going to be like 1% here, 2% here. It's going to just be that slow drain. So for me, that's worst case scenario for the SPX. Now, let's do the opposite, right? Let's say we use the data from the post-election years and we don't get a cool off, we continue to get a melt up. Now, ultimately, what we could see is, again, we still have the first 2 weeks of May pretty hot. The next thing we would possibly see is like we get a little bit of a cool off in the middle of May, and we come back down here. But the difference would be that run up going into Memorial Day, June, it would continue, and we probably run into quad witching and tap up to 4,400. Uh-oh, didn't mean to do that. Let me delete that. Sorry, guys. And you just have a straight run up to 4,400 like that, right? And then that's just going to create a massive, massive melt up there. And then, of course, again, when you get a 4,400, and if you look at, say, what is a 10% rebound from there, or a 10% decline from there, 10% from 4,400 puts you roughly at 39.48, which is what we said is our support of 39.79. And if I just change it to the candles, you can see it comes back and it cleans this up. Now, again, it would not be a straight drop like that. But what I'm trying to show you guys is that, yes, we could possibly hit 43, 4,400. And then when we get a 10% correction, look at where a 10% correction would, the levels it would bring you back down to. It bring you back all the way to 4,000. That's a lot of points. And when you think about that from an individual stock perspective or an ETF perspective, you know, those are going to take, you know, anywhere from 10 to 15% hits, because remember, there'll be some stuff that might be going, like there'll be sectors that are continue to be gaining while some sectors are losing, creating somewhat of a rotation. But overall, you know, this is what you gotta, you know, look out for or be prepared for, is another 10% correction in those levels it could bring you to. So that right there is the SPX, kind of like how you could see things going from May to June. And then ultimately, I do believe July, we start to rebound into the back half of the year to get back to our levels of 44 to 4,300, right? So on the SPX or the S&P 500, because it did not do a full correction back in March, it only did, and if you don't believe me, this was the top. We got as low as 5.5% pullback on the S&P 500. So it still needs a 10% correction. So yeah, the SPX still needs a 10% correction, so it could be coming. Now, let's look at the Nasdaq on the flip side, because the Nasdaq experienced a 10% correction already, right? It actually experienced it more. If we go from the high to the low, this was actually 12.35%. So it's already gotten its correction. So what we could see as far as we go into June for the Nasdaq, say we get to our 14.5, right? So if we draw this out, we go back to the line, just so you can see it a little bit more clear. We get a nice bounce those first 2 weeks of May, right? And we get to our 14.4 target or so. Say we trade flat a little bit into May. Well, may even come back down here to May. And then we get another double top going into that Memorial Day weekend right here. Now, when it comes to the Nasdaq and its pullback, right, a 5% pullback, say we got a 5% pullback to about where our support is right here for quad witching, right? So this is quad witching right here in the middle of June. I don't care. Don't pay that no mind. What I want to show you though is from a info line perspective, going from 14,500 down to this 13.5, that's only a 6.8% pullback. Now, mind you, that could be the low, but if we say we hit this level, but we pull back and we finish here, right? So it comes tap here, but we finish up here. That's 5.38%. That's a 5% pullback for the Nasdaq. And then I'm gonna bring it all home when you look at the Dow Jones, because that's what could cause the S&P 500 to do a 10% correction. If the Nasdaq does a 5% pullback and the S&P 500 does a 10% correction, what's left? It's going to be the Dow Jones, and we'll get into that in a second. But I just wanted to show you how we could go from 14.5 back down to this 13.5, right? That's only going to be 6%. And if you look, y'all know how I feel about my gaps. It fills this gap, right? It will come fill this gap, and then ultimately it will complete like all of this, which would allow us to continue to bounce and head towards 16,000, which is, you know, the Nasdaq's end of the year target. So if you look, and if I just I'm sorry, I had to delete that. But for all intents purposes, if we go to the info line and say if we get to the middle of June and we are back at 13.5, right, after quad witching, July is usually historically a great month for the market. So if you look and tech bounces back in July and we go just to get back to even, that'd only be a 6.7% gain. We would expect the market to do half of what it lost. So if it did half of what it lost in the whole month of July, and we just say the Nasdaq runs up about 11%, by August that could put us at 15,000, which means we're on track for 16,000 by the end of the year. So you could see a hell of a bounce from the end of June into July on the Nasdaq. I'm talking, like Tom Lee said, face ripper bounce when it comes to the Nasdaq end of June into July, from about 13.5 all the way up to about 15,000. That's only 11% move. And we know if I just show you right here, it did 9.35% in 19 days. So this is a very doable move once we get back down here to go back up to about this 15,000 level. So again, these are just my thoughts. These are just my perspectives of how I see the market potentially playing out as we go into May, June, and July. And then to bring it home, right? So you got to add in the Dow Jones. That is another index. And when you think about some of the stuff that has already run for the year, things like financials, the industry sector, those need to correct. They have not corrected yet. So when you look at the Dow Jones, and the Dow Jones has not corrected yet. When you look at what happened in March, it did a little pullback right here. So it hit here, it went to the low. So when you look at the Dow Jones in March, when things started or February, when it started to cool off, from February down to that first week of March, it had a 4.5% pullback. That was it, from high to low. Then it recovered, and since then it's continued to run, which gives me that, hey, we're starting to get to the top when it comes to the Dow Jones. Add in the fact, when you look at it right here, as far as the RSI, you have divergence. We made a new top, and now we're starting to come down, right? We made this top, crept up. Now we're going to start to come down. We're so high on this RSI. So we're going to have to start pulling back a little bit. So when you look at the Dow Jones, again, the Dow Jones may have a little bit more leg room, which means like, hey, it may come down and then just going to start that slow divergence. But even though it's starting a slow divergence, it could make a new high as far as this 347, right? And that's ultimately where I see it kind of topping out. Now, from 347, if you do a 10% correction on the Dow Jones, and if I show you guys again, 10% correction on the Dow Jones would bring it, boom, right around 311 or so, 310. Now, of course, it's going to go a little bit deeper, right? So for all intents and purposes, if it comes right here to where our support is of 306, that'd be 11.5%. Remember, the Nasdaq from high to low was about 12%. So again, it matches up. Everything's not going to be one for one, but you want to get into the like a good relative comparison basis. So to see the Nasdaq do 12%, okay, the Dow Jones should do about 11.5, 12% from its peak to trough, right? So don't be surprised if you see this DIA ETF get up to about 345, 346, and then correct all the way back down to about 305, 306, which is in line. And that also would give the 50-day exponential moving average time to catch up. And then of course, this would probably meet somewhere around here, around this 325 area. And so when you put all of that together, the Dow Jones correcting 10%, the Nasdaq pulling back 5%, that's what gives you an S&P correction of 10% in June quad witching. If that's my bear case scenario. My bull case scenario is that we don't see those corrections and we continue to run all the way through May, June, and July. And then August, we start to kind of cool off. And then September is ultimately when we would have the big 10% correction. We would see the Nasdaq correct somewhere around maybe 5, 6, 7%, or pull back to about 5, 6, 7%. The Dow Jones would do about, like we said, 10 to 12, maybe even 15%, depending on how high it runs, which causes the Nasdaq like we said, or I mean, the S&P 500 to do a 10% correction in September. So I know that was a lot. I know that was a lot for you to chew on. Again, I would love for you guys to comment your thesis, how you see things playing out going from May, June, July. Challenge me on it, because that's how we're only going to get better. Now, ultimately, don't take this as you need to take an action on your portfolio. Take this information and analyze, how does this affect my portfolio? And if it does affect my portfolio, what changes or things should I look for, or what can I do to protect myself? Remember, this is not investing advice, and investing does carry risk. So this is for informational and educational purposes only. All right. Now, with that being said, guys, that is the Setup Sunday episode. Wish you all the best of luck within your trading journeys, and I will catch you guys next week.
All right, family, I appreciate you guys for sticking with me through that video. As I mentioned, these are my thoughts and my thesis and my perspective only. Feel free to challenge me on them as you see fit. If you see something like, hey, Zay, I got different data that points this, it could be true. Again, nobody can really predict the stock market. I'm just putting together the pieces of the puzzle that I see and trying to paint a picture as best as I can for myself and share it with others. So again, as I said before, do not take this as you need to take action on your portfolio. This is really just for informational and educational purposes only, guys. So I really hope y'all enjoyed this. As I said, I will catch you guys next week for another Setup Sunday. And y'all know the phrase, stay blessed. Peace out.
Run it up, run it up, run it up. We out for generational wealth. Who else but us? Run it up, run it up, run it up. This is first gen wealth building.